I'm John Sleeting, your host, and today I'm joined by Tyler Beachler.
Just preparing the company for an exit is a, process in and of itself, let alone just the financial aspects of it. Does the deal make sense? Am I getting the value for it?
Right. Some of the items that come in, even in the bond side of the world, is that shorter term bonds, longer term bonds? Is that credit risk? How much credit risk?
Things get expensive, things get cheap relatively. It's not a situation where you want to go all in into one asset class or all in into, one hedge or anything like that.
Yeah.
But those things give different opportunities then in the portfolio for us to be diversifying risk, to be preserving wealth for clients.
Hello, and welcome to Clear Conversations, the Entrepreneurial Legacy Series. I'm John Sleeting, your host, and today I'm joined by Tyler Beachler. I'm guessing those of you that are familiar with Clearwater Capital are also familiar with Tyler Beachler. He's the Deputy Chief Investment Strategist and leads all the portfolio management activities on behalf of Clearwater Capital's clients. He is a fantastic individual. He's been with us for over a dozen years and continues to innovate and develop and think through what's happening in the capital markets, both public and private. You've heard him previously on this podcast a few years ago as he discussed investing across the Entrepreneurial Legacy Series. And today we're going to go much deeper into private markets. We're going to talk about the developments within the firm, within the world more broadly in terms of private markets, concepts from democratization of private markets. What does that mean? Is it a good thing or a bad thing? And how investors really should be moving forward with caution, but not avoiding private markets. They absolutely do play a role within a diversified portfolio, and we'll get into more depth of what exactly does that mean. Leading up to this podcast, you heard from our M&A mini-series that eventually evolved into a live in-person event that we did on succession and exit planning. A lot speaking to different perspectives when it comes to private direct investing, and I encourage you to go back and listen to that. We also got into decoding of crypto and speaking to Hunter Sims, who joined us when he was in town from the University of Cambridge in England, and speaking through the developments within decentralized finance and what that segment looks like. Then we spent the last three episodes on family governance and the core and the meaningfulness of investing with purpose for the benefit of your family, how to think philanthropically. It's something we'll come to in 2026, and the minimization of taxes as really the three buckets between your family, charity, and taxes. But family governance as a subject unto itself. And we had three just unbelievable experts in this space, industry-wide, even globally, I would argue, between Kirby Rosblock in her firm in Tamarand, Amy Castoro at the Williams Group, where she's the president, as well as Gary Shunk in Aligned Family, and how families can come together, right? Because all the financial capital in the world sometimes can't buy happiness when it comes to harmonious families and the human capital in this lived experience that we have. So I do encourage you to go back and listen to and take in those episodes. But as you go through this episode, as I've encouraged before, think about who could benefit from considering private markets. That they're not just accessing the latest thing that they hear maybe at their club. They're not accessing something that somebody's just sending them coldly into their inbox. But there is really a disciplined way to approach private market participation. We have our deep convictions, as we do on a lot of matters. And so I look forward to exploring this in this conversation with Tyler. Tyler, thank you for joining me again in the studio. It's been a few years since we sat down, and a lot has transpired for Clearwater Capital, the world, these private markets, changes in administration, policies. So it's really going to be a great way to kick off the year, right? So Happy New Year, everyone. And here we go. We're going to go a bit deeper into private markets. So Tyler, first of all, you're no stranger to the studio with me, right? We recorded an episode back in the fall of 2023, and there we shared on investing over the entrepreneurial life cycle. So before we get into private markets directly, and as a bit of a macro update, let's rewind and do a bit of an abbreviation of that discussion regarding the phases, the thought process, the technical aspect for a few minutes, and then we'll get more into an update of where we're at with private markets and how that's playing out for clients too. All right, so let's go back. Rewind 2 years ago. What's the synopsis about investing over the entrepreneurial life cycle?
Yeah, well, first, thanks for having me. It's good to be back. And all the episodes that have come out the last 2 years, it's been really remarkable to see, and all of the phenomenal guests that you've had on. So to be back again, I'm excited. So thanks for having me. Last episode, we kind of touched on the entrepreneurial life cycle in really 3 distinct phases: the startup phase, the growth phase, and then the mature/exit phase. And so we stressed heavily in terms of the importance of planning well in advance of the mature phase. Not that you can't do any planning, estate planning, investment planning, cash flow planning, whatever it may be. Not that you can't do it at that point in time. However, leveraging the policies, the tax policy to your advantage, the benefits of planning well in advance of those exit phases is super important.
And this is where I reflect back on a few years ago in that episode, and some refinements, asterisks, addendums, or however we want to phrase that, because I do want to separate out for listeners, if it's your first company, right, the startup phase, you're bootstrapping it, right, you leverage yourself, however you got to developing that business, that's really more of what we were referencing a few years ago. If there's someone out there that's thinking of a startup phase, but it's their second, third, fifth, 10th company, right? More likely than not, we're now structuring that in such a way that it is outside of the taxable estate. So all of that growth now is part of the estate tax planning, wealth transfer strategies within the family. They're not doing it for the money. They're doing it for the intellectual engagement, the drive, the purpose behind who they are as individuals, and what that may mean for future generations, for charitable purposes. But the focus in the first episode was somebody really more starting with their first company versus how they be thinking about that second, third, fourth. So I do want to even draw that distinction in that startup phase.
Yeah, absolutely. And that's where, for those families then too, where we ended up getting to was, okay, how do you actually look at your business as an investment, just like you would any public company, any real estate purchase that you've got? Because any investment of time and financial capital into your business, you're expecting some return of cash flow at some point in the future. Now, that may be way further into the future, depending on the stage that you're in. But I think that's where the applications apply kind of across the board. But agree, focusing specifically for that first generation and the last one.
And this gets into placement, right? One other thing we talk about within the overall estate structure. I remind individuals all the time, a lot of people want to talk about investments and they want to, let's talk about the investments. Let's talk about the deal. Let's get into whether it be public markets, private markets, in terms of how they're thinking about it. But void of the context, first of the legal structure and the tax structure, right, and the financial structure in terms of cash flows and living and needs and how the leverage is set up or not, depending on the structure. You really have to start with that first. As you get into then where does it make the most sense for the investment? So this concept of placement, is it inside of qualified or non-qualified? Is it inside the taxable estate or outside the taxable estate? What are then not only the legal pieces, but the tax components that come in? Is it in a grantor trust strategy? Is it in a GPLP structure? Is it straight up in a legacy trust type structure without the GPLP components that allow for control versus ownership? I know listeners might be thinking, okay, this is alphabet soup, but it's exactly what we're talking about. In terms of the legal and tax structure, has to be really instructive regarding how the financial flows happen as well as the investment. And that's right for startup, but also into the growth phase as you think about the capitalization piece of it too.
Right, and that's where it gets into okay, each family is different, yet there's some common themes that may apply to thinking about placement, right? Depending on those estate, legal, tax structures, how are the time horizons for whatever capital we might be committing to within the taxable estate? Generally post-exit, you're looking to wind down some of those assets. You're looking to spend those assets. So liquidity becomes a priority within the taxable estate. Now, that doesn't necessarily mean, all fixed income, all debt, I just need my interest to live off of. But a diversified public market strategy that could include some equities, some fixed income, some other non-correlating assets in there too, is going to be a preference. Whereas outside the taxable estate, depending on the family's wishes, desires, risk tolerance, private market investments might be better suited. And then again, it comes into, well, which private markets? Well, if the goal is return enhancing, okay with longer, capital lockups because this money is invested for the next generation, that could be years and decades into the future. Well, okay, we might want to take a look at a larger allocation to private equity, maybe venture, other equity investments there.
This would be a good point for us to pause and give the commercial for compliance that nothing that we're discussing today should be construed as legal, tax, financial, investment advice regarding any matter. This is a conversation between the two of us that people happen to be listening into. But everyone does need to really seek out, in terms of their best understanding, seek out their professional team and advice. Yeah. If they want to engage us in a conversation on these matters, please do. Reach out to us at clearconversations@ccpwealth.com. Go to our website, ccpwealth.com, because this is that important. And it's not as simple as people are just like, well, then just put it here. Right. All too often we hear individuals, whatever the saying might be, right? So you're saying that ship has sailed. So I would do that completely differently now, given what we've explained versus not. We've gone through these scenarios with individuals to have some refinement at this point in time, given maybe what they did before they were introduced to us. So there really is. And we take the caveats. I say that, part joking, but also it is that serious in terms of the nature of this, because people can get themselves into trouble, legal, financial, tax, right, with how they make these decisions if it's not well thought through. So I say that with all sincerity and seriousness as people are seeking this out. If this prompts a thought, please reach out to your professional team, reach out to us. We'd love to engage in that conversation.
Absolutely.
As we move into the growth phase, or from the growth phase to the maturity phase with respect to monetization events, how does that play in then for individuals? What should they be thinking about at that point?
Yeah, I guess I would say, as you're just preparing the company for an exit is a, process in and of itself, let alone just the financial aspects of it. Does the deal make sense? Am I getting the value for it? Who am I selling to? Who do I want to be selling to? What's the legacy that I want to leave with it? So there's obviously a ton of those considerations when preparing for an exit. And then, it also becomes a question of, okay, as I'm considering a sale, how much is coming to me? What are the different tax and legal structures that the money's going into, depending on ownership? Oftentimes there's opportunities for roll-in to whatever the new venture, the new co might be.
So pause on that. Yeah. Let's get to tap the brakes, so to speak, right? So as we start getting deeper into this thought process, so you use terminology of roll-in and new co, and let's go back through that in a transaction case study, so to speak, of what are you talking about, right?
Yeah.
So let's rewind a little bit. Yeah. What does that mean? How should somebody be thinking about these subjects, and let's define them a little bit more precisely.
Yeah. So oftentimes, let's just say first generation entrepreneur has his company, has grown it, and he's now ready and, at the point where he's willing to, kind of step aside, at least from an ownership perspective, and let's assume a, full liquidation of his ownership stake.
His or hers.
His or hers. Thank you. Oftentimes, the acquiring company could be private equity, could be a strategic co, wanting to come in and acquire oftentimes present multiple options that need to be considered. Is it the assets? Is it the equity? What is actually being sold? And then even different financial engineering in terms of what those offers can look like. And one of the ways that we've seen, and you've seen too with your clients, has been opportunities for clients to roll into the company that is acquiring. So now this, let's just say, a merged company that may have this interest and a few other interests, of giving the seller then an opportunity to become a buyer into this new entity that has just acquired the company.
In one aspect of that, and I do encourage listeners to go back earlier in 2025, we had a 5-part series on mergers and acquisitions. You can find it in this M&A mini-series. Included in there are different episodes with different individuals and different perspectives. From an investment banker that I worked on a transaction with. We also referenced a conversation then with Kip Pendleton, who was on. We got approval from the family where we served on the board together, going through a transaction and the different process decision points from strategy to execution on that would be. The only nuance I'd have in the rolled equity, and make sure that listeners are talking through this with your accountants, that your rolled equity is carrying forward your basis on your existing. So instead of it being a new investment where you're resetting basis, you do want that to be explored and structured in such a way that the part that is retained as equity in the new company, the buyer, the platform company, whatever it might be, you do want that to be a tax-free transaction for yourself, where you end up having the capital gains on a subsequent liquidity event. But the first one, where the taxes get focused on really what you might be selling versus the rolled equity of what you're putting into the new transaction. Right. Your contribution in retains your cost basis. Really need to be talking through that with your accountants at that point.
Right, 100%.
I want to shift gears for a moment. We've referenced for years and years the Global Family Office Report. UBS does a great job in terms of putting this piece out. What is in there that has captivated us so much that we keep going back to it to understand and watch the trends over time within the family office space?
Yeah, I would say what's captivated one is just the quality of the data and the information out there. I feel like in today's day and age, we get caught up in headlines, and a lot of people out there might be seeing, well, this family office is doing this, or this family office is all private equity, and I can't get access to some of that. And we create these misconceptions, I think, of what the super wealthy single-family offices are doing in their investment portfolios. So I think some of the interesting thing is just the amount of diversification in those portfolios, both public market and private markets. The emphasis on liquidity, the amount of cash and public market exposure to be providing then the opportunity set, the availability then to invest in opportunities as they come up, because those can be every so often, time after time they come up. But so I think there's a few takeaways there that say, okay, that there's some really interesting takeaways and thoughtfully crafted strategies that they're employing for their $1 billion and up family office.
Yeah, and I think the range is from a few $100 million to several $1 billion in terms of the people they survey. But it is this capital allocation piece. As listeners, longtime listeners know, I sit on the advisory board for the Family Wealth Alliance. Total assets under management approaching $1 trillion, right? A few trillion in total wealth. And even there, when I ask the question, well, what does allocations look like, right? How do people think about allocations? When we look at the Global Family Office Report in allocations, right? I mean, let's go into a little bit more of the public versus private. What does that make up to today, roughly, and directionally around the world?
Yeah, so globally on average, it's about 55% of the allocation is public market exposure, public equities, fixed income, cash generally. And then the other 45% then being private market exposures, equity, debt, real estate, small allocations to collectibles, passion assets, things of the like.
And this surprised us. to a degree, but also you step back and not surprising.
Yeah.
Someone that goes through that entrepreneurial life cycle, right, from their startup to their growth phase, now the maturity, they have an event. They have, so as the saying goes, right, they're not trying to get rich. They've gotten rich, so to speak, in terms of the event that they've had. Now they want to stay rich. How do you do that? Well, you got to diversify more broadly, right? And you end up with the access to public markets, the liquidity that's provided, the efficiency of the public markets. We'll come back to that further. But it's also instructive because it doesn't mean it's void of private markets. And yet there's that balance that has to come in. This is what's the right asset allocation for an individual, for a family, across generations, and these considerations that come into play. So on one hand, there might be the wrong perception regarding everyone watching Shark Tank, right, in terms of the great education that takes place with individuals watching that, but then thinking everything is tied into startup type businesses and small ventures that are out there. It's just not. And these are some of the wealthiest families around the world, and not just in the U.S., that have a majority of the assets over in cash, stocks, and bonds.
Right.
It's more boring. It's more efficient. So let's talk public first before we turn over to private. Like how does Clearwater, how do you and why, as a CFA, putting on your CFA hat and thought process and with the team and thinking through this, technically approach the efficiency of public markets?
Yeah. So
and why?
Yeah. And you hit on a key point there in terms of the efficiency of public markets, because I think we touched on this a little bit last episode too.
So let's define efficiency. What does that mean?
When you look at when you're investing in these asset classes in these markets, there's a lot of different ways to do it. There's passive strategies, there's active strategies, stock picking, for example. And then
active.
There's
So stock picking is active. Yep. What would be what would be an example of a passive?
Like the S&P 500, investing in a fund that tracks the S&P 500.
Okay.
And then you've got strategies in between those that are more rules-based, data-driven type approaches that are looking at a stock's, for example, investment qualities, factors such as value, quality, momentum, size. So you've got all of these different strategies, way to access a particular market. Let's just use equities, for example. But what we find is all of those strategies, the dispersion of returns, whether it's passive, active, or something in the middle, between top quartile strategies in public equities versus, bottom third quartile type strategies, really only like a couple % difference in terms of the returns there. So getting access to public equities is just a great way to get started. Now, we obviously have convictions in not a perfect way, but what we think is an academic-driven way of accessing those markets. However, getting exposure, getting diversified across the total portfolio within an area like equities in the public markets goes a long way.
Well, and so what's our philosophy, and kind of peeling that back even a little bit more, very academic in the thought process. Why not, if we can stock pick, well, what about managed mutual funds? And when I say we can't, it's we choose not to for the same reason we choose not to be in managed mutual funds. Why is that? Yeah,
we just look at the data and look at the research. There's some great research done by S&P Dow Jones Indices, something called the SPIVA report, that takes a look at all these active managers. They all have their stated benchmarks. Well, how do they actually do? Because generally, they come with higher costs. A lot of research trying to beat the benchmark that goes into it. So generally, they pass on those fees to end investors. But are you actually getting the returns back, for the higher fees that you're generally paying? And what the SPIVA report comes out and says is, over long periods of time, say 5-10 years or so, upwards, depending on the asset class, of course, most active managers underperform their stated benchmarks to the tune of somewhere, don't quote me on the exact number, but roughly around 90% or so. So as we look at it, say, oh my gosh, there's a lot of active equity managers that are out there. that many are underperforming their benchmark and you're paying up for that underperformance, maybe we should be considering other avenues of exploring the equity market.
And we also step back and saying, in our own humility, if they can't do it, why would we think we could? Now, it doesn't mean we don't have individual stocks or we have options to protect concentrated risks. But when it's like, here's a bag of cash, how would you invest it? It's not going to be out stock picking, and it's not going to be into those managed mutual funds because they tend to underperform. Doesn't mean always and every year. But there's also lack of evidence of persistence of the ability to beat. So we look at that and say, well, that doesn't make sense.
Yeah.
So what about straight up just index funds? You said those are passive in nature. So if that's a better way, why not just an index fund?
For some people, it's just a great way to get started. It's a low cost, super liquid, low turnover way to get exposure. Where we say, okay, maybe it's a great start for investing. We say, okay, maybe that can be enhanced a little bit by trying to marry what rules-based passive indices are doing and what active managers are trying to do with something called factor-based investing. I hit on it just briefly a little bit, but with the advances of technology, some of those strategies can really reduce the cost and then invest in companies that aren't weighted based on how big they are. We've got some phenomenal companies in the S&P 500 index, of course, but they're getting really expensive, and their weight of that index is continuing to grow
because
higher
they're all
and
market cap weighted.
Because
a
it's
bigger
all
company
market cap.
has a bigger weighting, a bigger company.
And we're just saying, okay, well, maybe there's alternative ways of doing it from something simplistic that is just saying the biggest companies. Because what we see over time in decades, there is turnover in the largest companies within the S&P 500. You go back to the days where you had, companies like AT&T, Verizon, GE was there at one point, IBM. You've got all these different companies that were at the top for one period of time. Trees just don't keep growing to the sky. So especially now with the concentration in the top 10 names, considering alternative weighting ways of investing in equities is something that we've been doing for a while.
And so with the proverbial better mousetrap, right? The thought that would be, well, we find and data supports that the factor weighted methodologies versus just the passive index or even the active manager, because it's more cost and tax efficient because of the capital gains treatments, which is all beyond the scope of this conversation, right? We'll come back to that separately. But the efficiencies that are there, factor-based methodologies, not artificial intelligence, but rules-based methodologies, have proved more fruitful with respect to their benchmark than not.
Yep. Over long periods of time, we like to say it's an overtime strategy and not an every time strategy.
And the core asset allocation explains 93%. So some of these items people have heard from us over time. So if you've got questions on some of these fundamentals, we're laying the ground here to turn the corner into private markets. So we talk about cost efficient, low cost, tax efficient, not distributing capital gains, the efficiency of the markets, the liquidity of the overall public markets coming back in. It's very tight. And if asset allocation is the explanation for 93% of return and variability of return, great, then that's what we're going to focus on, and that's going to be the core of it, given that dispersion of returns is very small.
Right.
So that's public markets.
Which,
Now,
and if I could just jump in, because you brought up a great point too, and I think, and I know we're going to get into privates, but on this topic of allocation, I think that speaks to why we've seen these, single-family offices, why we've seen their allocations be really consistent over the multiple years that we've been tracking it, because they've got their allocations. Again, each single-family office is going to be different. Each family is going to be different in their allocations. But they have this understanding of how those investments should be allocated and sticking to that plan consistently over time. I think there's a lot of power to that.
Yeah, and so now I feel compelled, because you're building on it, is for us to pause and be like, well, what is the asset allocation decision? Right. Some of the items that come in, even in the bond side of the world, is that shorter term bonds, longer term bonds? Is that credit risk? How much credit risk that you take in? On the spectrum. What happens with the U.S. dollar? Are currencies going up or currencies going down? What does that mean for international? Do you hedge out the currency risk or not? there's a lot of complexity that comes into the asset allocation decision.
Yeah.
This isn't just U.S. stocks, international stocks, bonds, and I'm done. No, there's a whole lot that takes place in the inner workings of what that means, and still then overlaying with this factor-based methodologies too.
Right, because there's cycles to these things. So you want to have your strategic allocations, and at times you're going to want to adjust those allocations, called tactical asset allocation, where we might be wanting to lower the duration or lower the maturity profile of our bond sleeve within strategies, right?
Right.
So those things do ebb and flow throughout time. Things get expensive, things get cheap relatively. It's not a situation where you want to go all in into one asset class or all in into one hedge or anything like that.
Yeah.
But those things give different opportunities then in the portfolio for us to be diversifying risk to be preserving wealth for clients.
And so as we start talking a little bit more about private markets, or reminding individuals, you can go back to our website, ccpwealth.com. There's an introducing the private markets webinar that we have that's out there. Maybe we can even tie that in somehow with this podcast, because we spent a long time with our entrepreneurial clients and families that we serve, because they get to a point going, okay, if I sell the company, I don't go from having my private direct investment. So when we talk about private investment, if you own a company, yes, that's private equity. It's your private equity. If it is owned by you or you're in partnership or business partners, that's direct investing. It's you're directly with your private equity investing in that business.
Yep.
And so if done correctly, they've diversified away over time from that concentrated risk. They've gotten a better balance of the portfolio over time, even with their direct investing. Even if they never sell, if the succession is intra-family, that's passing down through the family, over time they've still diversified away into public market holdings to reduce the risk and the volatility of what may come into place given what they've grown and achieved. At the same time, these are individuals that know how to manage risk because they created their businesses over time in terms of how they've approached. For us, in the introduction of our private markets platform, who is this for? Let's just talk a little bit about the individuals and difference between accredited investor, qualified purchasers, and who we're speaking to at this point.
Yeah, so most of these investments on the platform are for qualified purchasers only. So generally for families, $5 million minimum of investable assets. For corporations or other foundation type entities, there's some nuance in terms of the definition for those, but generally that's $25 million of investment. So when we're talking about private markets, these types of investments, you hear us say all the time for qualified purchaser only. That's kind of the bare minimum to even get access to these types of investments.
Okay, so these are for client households or individuals that might look to engage in this conversation. Minimum of $5 million of investable assets and above.
Yep.
So that's who this is for. Then we look at it and say, okay, just because you have $5 million doesn't mean you automatically should be investing in private markets. It really is back to the makeup of the overall balance sheet, the legal tax financial structure that we talked about earlier. But if someone was to say, okay, I want to approach these private markets, are you approaching it in the same way you do public markets? Are we talking about fund structures? What's different between public and private markets?
A lot, but I guess where I would go with that, because you mentioned introducing public markets as efficient, and we want to be very selective in terms of how we're accessing the private markets. Talked about the dispersion of returns within public equities being about 2% or so. Within private markets, let's use private equity as an example, the dispersion of returns between top quartile manager, bottom quartile manager can be around 20% or so in difference.
20 percentage points.
20 percentage points in absolute, which is super significant. And that's even if you're, let's say you're in the same asset class, the same vintage year, all of those things line up, but you pick the wrong manager, can have significant ramifications. So even where I was like, passive investing in public markets is a great spot. You see a lot of these, access vehicles or accredited investor strategies, democratization of alternative investments. I think there's some good to it, but I also think clients, investors need to be aware that manager selection's a big deal, and what are you actually getting? What is the manager you're actually investing in? So I think there's some caution that needs to be warranted with some of those strategies.
And this is what I've heard from individuals, right? And it's the mental gymnastics of just separating those two items. We're not talking out of both sides of our mouth, right? Public markets are efficient, and there is a way that we believe is a great way of efficiently accessing those markets without incurring the additional costs of managers or the tax inefficiency of managers versus the rules-based methodologies that we mentioned. And this is completely the opposite. We absolutely want access to the top-tier managers because the manager and the access and the approach absolutely does matter as you look at that. That piece, those two things can exist at the same time. And it is really important for individuals to understand that those aren't separate. There's just different dynamics that take place, and that's what we'll get into more. So always be thinking, public markets, very efficient. How do I think about capital allocation and the totality of that? Private markets, very inefficient. Now, how do I get to the top managers? And this is where you spent a few years going through a process to really get our private markets platform launched in some of the decision making. And a few of those items, I'm just going to read off of a page. This comes out of actually our webinar segment. And these are the high level, right? So as listeners are going through, don't write these down. If you got questions, give us a call. But as you think about investment offerings, exclusivity, diversified across asset classes, manager track records and experience, co-investment capabilities, research and due diligence, investment due diligence, operational due diligence, research team members, frequency of contact with managers, alignment and governance, independent ownership structures, history of the firm, free of conflicts of interest, principal investors alongside clients, operational items, including subscription documents, tax documents, capital calls, fund administration, technology, including performance reporting, third-party integrations, custody relationships, cybersecurity, cost structures for the manager of the platform, and overall negotiated fees. These are the high-level items, right, that we spent a lot of time on and saying, how do we do this on behalf of our clients to figure out how we want to be accessing the markets, for Clearwater Capital, for client families in the way that we're looking at it. Going through that process, knowing it took you a few years to do it, this is not something somebody's going to do on the side or understand or be able to get to a level of detail, even if they think they know it from the whole country club deals, right, of somebody talking about getting in with the manager. The access and the exclusivity is one of the things that you hit on here. What is it about the makeup of the platform that we have and the manager access that we have that makes it attractive? Not in and of itself, right? It's not just the attractiveness of the investment, but the attractiveness of the overall package.
And all of those categories had relative levels of importance too. Cost versus technology versus operations, and then of course stressing the access and the due diligence a bit more in that search process was big. But in terms of the access, as we were looking at all these different platforms, it became abundantly clear that some of the platforms were really just focused on providing the most amount of access to all of its end clients or partners or whatever it is. And so as I was going through this process, it was like, okay, do I want that? It seemed very retail. It seemed very watered down. Again, I think there are some great things to democratizing alternatives. However, there were just some platforms where it was like, okay, is there any due diligence being done in the selection of what becomes on the platform that's available to invest? Are these, household, the largest names out there that are really just trying to evolve their LP base to say, okay, we've tapped into, the institutional. Now let's tap into wealth. Let's tap into retail just because we just need to keep raising more and more dollars to have the growth. So that was another key thing that steered away from some of the platforms.
So I'm going to tap the brakes again on a few definitional type items. GP, LP, institutional, right? So who is a general partner? Who is a limited partner? The access, to capital flows, what's an institution versus non-institution, add some definition to those topics.
Yeah, so general partner, I guess, in a simplified definition is, think of it as the manager. We reference managers, active managers or not. You can think of the general partner as the fund company that's raising a fund that is going to be going off and allocating those dollars then to finding investments in underlying portfolio companies using private equity as an example. The limited partners then in that instance would be essentially the client base that is committing dollars to that fund for the general partner to go off and make decisions on which companies to be buying and how to be allocating those dollars.
And so if we think about what we're talking about is not a fund of funds, right? Some people would default there. Our platform is not a fund of funds. It is access to the managers, to the general partners.
Correct.
In the approach. And it is a bit of an institutional approach. And why do we say that? Can you share, some of the minimums that are out there for some of these managers? If you were trying to go directly off the street to some of these managers, where are some of the minimums at?
Yeah, I would say, so in terms of the investor minimums, if you were to go off the street to some of these managers directly, some of them range from $1 million, seen several at $10 million, seen others at $25 million. So generally, when you're dealing with managers that have that type of minimum in place, it's usually the large institutions that can be making that type of minimum allocation and potentially more. The other thing that I've seen across some of the managers on the platform has been limited partner bases, which I actually like because it's not like a situation where a general partner is really scrambling to say, okay, we need to launch the next fund and we really need to tap into the wealth and retail because that's just the next, source of capital that we'll be able to get.
We'll come back to that.
Yeah.
We'll come back to that.
So I'd say that also speaks clearly too. I've seen some funds too that have, 13 to 15 limited partners in their fund, and we're able to participate in that. So I think that speaks to, again, that doesn't alone make a general partner or a manager really, really good. You still have to do your due diligence. But as we were trying to find the right partner and the right platform for our clients, having that type of institutional feel, exclusivity, really spoke volumes in terms of that.
And our clients don't have to have the $25 million
Correct.
minimums to participate. We can be participating at much lower levels.
Generally 100,000 or so,
100, 250 in some. So that participation level because we've got access now to top tier, but how that comes together. So then the question I got asked by some is saying, well, what's in it for Clearwater? Why are you repping this platform in terms of, and that's not it at all.
Yeah.
I usually go back and share with people. I'm like, whether you're in treasury bills or private equity, we're actually indifferent. Our revenue, which is only paid by our clients, in the way that we look at, well, a treasury bill is an asset under management, equity is, or a private markets fund is, or a co-investment is, right? I mean, those are all just private. So we're indifferent in our fee structure and the revenue back to Clearwater based on the allocation. Now we're looking at it going, now what's the right thing for the client in the overall makeup when we go back to that legal tax financial structure and how they might be participating and how they might be approaching it.
Right. So it really does come back to what is that right allocation for the family and us be able to say, okay, we think private markets, whether it's, private equity, debt, real estate, whatever it may be, makes sense for this family. Okay, well, what is actually the best way that we can be providing that access, doing the due diligence to give them that institutional quality approach to private markets? And like you said, there's no incentive for us. It's just about trying to create the best long-term resilient allocation at the household level for that family.
Yeah, what's the saying is that be skeptical of any club that will have you as a member. Right? To be like, okay, well, why? Why did, by the time you got to me as a member, right? I want to be a member of the club that won't allow me in. That's more exclusive in the nature of it. So because that exclusivity is important. My starting point when clients send in, right? Because our inbox gets hit with all kinds of investment opportunities and strategies. It's like, by the time it makes it to my desk, there's a lot of people probably smarter than me that have already turned this down, so they're trying to go raise capital on it. And I say that a little tongue in cheek in terms of going, that's my starting point is no. And then how do we go from there? Doesn't mean that we don't have private market investments outside and away from our platform where it makes sense to add or augment what we have through our private markets platform. So it's not all or nothing, again, because we're indifferent in terms of our revenue structure based on what's the right thing for the client. And how we want.
And there's no agreements that we have in place in terms of platform investments versus, and you touched on this very briefly, non-platform investments, and there's no platform has everything. So there are going to be strategies that make sense. I think of 1031s. There's
what's a 1031? Got to define,
yeah,
right?
Sorry. So within real estate, generally, a 1031 exchange allows you to sell a real estate property, tax deferred, roll into a new real estate property. So you're not having to take the capital gain hit upon selling it. You can roll it into another real estate investment. So there's even some of those strategies that may be off platform that make all the sense in the world for a client going through that. So again, we're beholden to our clients and what makes sense for them
solving
and the
their
strategies
problem.
and exactly whether that's on
we got other
platform
partners
off,
to bring that in
exactly.
to do that exact. I think that's a fantastic example of solving what's the right challenge for the client family and how we approach that. So you've mentioned a couple times the democratization of private markets.
Yeah.
First of all, what does that mean, and is it a good or a bad thing?
So I guess what I mean by democratization of alternatives or private markets is you're seeing greater emphasis of general partners, these private equity, private credit managers, real estate, really opening it up to one, depending on definitions, accredited investor, so going lower in terms of the investment qualification where a lot more individuals actually qualify than on an accredited investor basis. And then two is the structure. So not every, but for the most part, we're getting into definitions and terminology here, but for qualified purchaser type investments within private markets, generally drawdown funds are the type of funds that you sign up to say, I'm going to commit $1 million to this private equity fund, but the capital isn't invested or even called on day one. They draw it down over periods of time. You're seeing a shift in even some of the vehicles to access private markets to be what are somewhat called semi-liquid, whereas those drawdown funds that I mentioned are usually you're locked up for 10 years or so. There are investment vehicles called interval funds, semi-liquid funds that say, okay, you know what, you somewhat trade like a mutual fund, but in order to get out, you have to go through the paperwork, and you can get out on a quarterly basis. So I think there's been changes in terms of technology, in terms of investor qualification that's lowered the bar. There's even talk about 401ks thinking about adopting. So you've seen this massive, I think, push from policymakers, from the industry, and I think from general partners too, to say, okay, private markets have grown. If we really need to continue this growth, to raise our AUM, to raise our management, we got to tap into other investor bases. Institutions are there and for the most part tapped out or just continuing their allocations. So how do we grow that base? Well, the wealth channel, the RIA or the retail channel is really kind of the remaining avenues for them to grow.
And so as they're striving to grow, be skeptical of any club that'll have you as a member, right? By the time the managers, right, and the funds, and it could be private equity, venture capital, or real estate fund, private credit, by the time that makes its way down to bringing in retail dollars for the sake of trying to aggregate up money, doesn't mean it's an absolute, but you forego the exclusivity, you forego the potentially the deal flow. There's a reason some of these managers have very high minimums in place because they're approaching it as an institutional set to serve a smaller, more limited client set, and how they're approaching it. They're not just aggregating up everybody's small allocation to that fund. And I think that could be dangerous, right? So we do encourage to proceed with caution if it's something that a listener is considering and what they might be offered. Be skeptical, right? Ask a lot of questions in terms of your digging in to our understanding of what you may be getting into or not getting into. Yeah. I think earlier in 2025, it was floated out there. I believe at the time of the recording, it's still out for discussion comment. So there's a discussion, and we can comment, right, on even private markets making their way into qualified plans, into 401ks and 403bs. And is that a good idea or a bad idea? So adding to the comment list that's out there.
It always depends, but generally I think, manager selection being important. So what are the managers you're actually getting access to? What is the ability of these, plan sponsors and their trusted, parties to be doing the due diligence on the managers that they're putting on to their 401k plan? Are the participants educated enough to even understand what private market investments are? What's a private equity investment? So there's a lot of those things that need to be, I think, checked first to say it's a great idea. If all those hurdles, then I'm okay with democratization of private markets, because I think private markets are just a great allocation tool for investment professionals to be educating, talking to clients how this makes sense, but for individuals to be trying to do it on their own, even with the assistance of plan sponsors, I would be very skeptical on that front.
Yeah. So I'll be a little bit more provocative. I think it's a terrible idea. And not for people to not have access, right? It's not about this small club of people that can access the private markets. But frankly, it's about the damage that could be done for individuals that may not have the time, may not have the CFA designations, may not have the years to put into evaluating how you approach this, to not only have the platform, but then the investment and the operational due diligence that comes behind that through our platform. Individuals aren't going to be doing that out there for themselves. And so I look at that. Again, this is not investment advice for anybody, whether you do it or don't. Consult your professionals. I just really struggle even with the concept of the concern, really, for people getting involved with investments that they may really just, and again, I don't want to insult anybody's intelligence, but they may not be as equipped to evaluate as Tyler, you are, and what you bring to our clients and your team and the team overall, and also the platform team that's even behind us. Because this is not insourced. This is not us doing this in terms of how we've approached it through the joint venture structure with the Vivaldi Family Office and First Trust Capital Management.
And I would add, too, education is so big in private markets, and that's the other thing, too. What type of vehicles are going into these, 401k qualified plan platforms? Are they drawdown funds, or are they more of these semi-liquid funds where you think you have liquidity, but then something happens and you need to roll over your 401k, or you need to take a distribution or whatever it may be? You go to tap into the liquidity and it's not there.
Right.
So there's a lot of coaching and education that certainly needs to go into investing in these type of funds and strategies.
And so PitchBook, who I've referenced before on here, is a great source of data and information flow within private markets. Coincidentally, they put out a piece just recently in here late in the fourth quarter. And it even gets into, on one hand, endowments, foundations, family offices such as us are focused on multiples and returns and are willing to take maybe a bit more risk to invest with smaller niche emerging managers to get to the right managers, the right deal flow, the right expertise. And they would be quite upset and worried if they knew that their general partner was going to go raise a bunch of, call it retail wealth capital, as they put it, private wealth, even where we distinguish as Clearwater Capital. We have our family office services for families, $30 million and above in the ultra high net worth community, versus private wealth that call it the $3 to $30 million range. Qualified purchasers are $5 million. So again, not a low bar to be gotten over for individuals that want to participate. and yet that exclusivity, the managers, the uptake, versus it just being administration that takes place. And there's actually a full white paper that was put together by the Institutional Limited Partners Association, right? So these are the big institutions. When I say that, think about major pension funds, right? Think about university endowments, significant investors that do have their private market allocation. If you didn't know it, they have their own association coming together in exploring these topics, because as you have the quote unquote democratization of private markets, that creates then challenges back into the institute. Not that it's a excuse the pun, a private club that has access, but it's there with safeguards and protections, because these investments, even when we go through them with clients, the awareness, the disclosures, the understanding of what people are getting invested in is significant. It's the same way if you thought back about your own company as your own private direct investment. If you were bringing in other investors into your company, or if you've gone through the process of selling your company, you know what it takes for others to do the due diligence of buying your company or investing in your company. Or if you were going to go bolt on and buy a company to add it to your own, the level of due diligence. Why would you not apply that same level or more of an outside third-party manager that's going to put together a private equity fund or a venture capital fund? You just wouldn't do it. And yet, if this was democratized, is everyone equipped to be able to go off and do that due diligence? I have a lot of concerns about it as a society of what people might want to get invested in. Even the title from the white paper from PitchBook, private wealth is the new crush, but institutional LPs still wear the ring, right? In terms of how the level of sophistication, this is not commenting on anyone's intellect, but what it takes to actually go off and make these investments and do this well so you get the right manager dispersion is a big deal. So with this, if this is not caveat emptor in terms of proceed with caution, if your 401k plan ever offers that in the future, if you're exploring this, there's a lot of questions to be asked of anyone you're coming alongside to answer to what was our satisfaction and why it even took 2 years with the client families that we're serving.
Yeah, and you touched on something too in talking about the investment minimums and just kind of the low bars to access some of these things. Private equity is just one broad sweeping asset class, right? There's sub asset class and sub strategies even within private equity. So in order to be achieving diversification at a niche or sector specific type strategy, where you are at, we talked about the stages of entrepreneurs and their business. Well, the same is true of investing, whether you're super early stage venture type investing or you're growth equity investing, leveraged buyout, or secondary type investing. So even within all these categories, debt too, real estate, there's all of these sub strategies that you want to be allocated to diversify within that, and then also diversifying managers. So whereas within public equities, you can have a handful of funds and strategies to be diversified there. Within private markets, given the manager dispersion, given the sub-asset class approach within each of those, it does require a lot of capital to be building I think, a thoughtful, well-crafted private market strategy.
Right. We talk about that often, right? So if we talk about private equity, so we'll come back to some definitions, private equity versus venture capital, what's the difference?
Yeah, so both are the same because generally private equity is simply saying, okay, equity investments in non-listed private companies. Venture, I guess back to your Shark Tank example, is more of that early stage companies where maybe they've gotten the initial funding from their own capital, from friends and family, and they've got this idea and now they're actually starting to gain some traction, but they need a whole lot more money to actually start getting it off the ground. Maybe there's not even revenue associated yet. Maybe there is some barely revenue coming in. And so they actually need to go through their first serious round of financing. So that's when venture really comes into play in those super early angel investing. Series A is generally the next stage of investing, Series B. So those earliest stages, again, with that comes the most risk because a lot of those startups It's not uncommon to have some of those investments go to zero, but then you might have others within venture that grow significantly.
So when we talk private equity, we talk venture capital. Right now, we're talking from a fund perspective, pooled risk, multiple different companies in a fund, and fund managers. Then the general partners can have a series of funds in terms of what they're raising capital for to go off invest as they're managing the companies within the prior portfolios. So what's a co-investment?
So a co-investment, and this can be across, equity, real estate, even debt. But to keep it simple, let's stay on equity. Oftentimes, general partners, as they're making portfolio investments, individual companies they're investing in, oftentimes either they're brought into another potential round where they can re-up and increase their allocation into a company, or maybe the company's just wanting to invest more and they just want to raise more money, and they'll go to the general partner and say, hey, can we structure something to get more financing? However, sometimes the general partner, depending on their current allocation of the fund within company A, let's say, sometimes they may not want to increase because that would be too concentrated of a position for their portfolio. So oftentimes they'll reach out to their trusted limited partners, again, the end client's investing in the general partner, investing in the fund, that has maybe done considerable business with them over time, to say, hey, my allocation is full up here. Would you want to invest in this direct company? Generally, what happens is they create a special vehicle called a special purpose vehicle where the general partner and the LP enter into agreements that it has its own terms, but the vehicle is actually owning just that individual company.
Just the individual versus a fund.
Correct.
So then what's the difference between a private equity and private credit?
So not too dissimilar from public equities and public credit, whereas in private equity, your stock in the capital stack of an individual company. Private debt, generally, you're just the debt holder, and that could be, senior secured type debt. Don't know how in depth we want to get here, but much higher on the capital stack in terms of generally getting interest in terms of what you're loaning to the company. So a lot of these concepts aren't too dissimilar from public markets. It's just there's more risk, liquidity give up. Companies that aren't mature as public companies are. So some of the things are applied to both. And yet at the same time, all the things that we've discussed previously that need to be taken into consideration when you're navigating private equity and private debt, just has to be there. Yeah.
So if anyone's ever made a personal loan to a friend or a family member, that's private credit, right? In terms of that extension, right? The extension of credit, making the loan, getting your interest payment, and collecting that money back. And now you have a manager that's out there doing that in various structures. And that continues to be a growing space. It's attracting a lot of capital. And they're also, we'll refrain from getting into any specifics on sub-asset classes in our current perspective because these things do work in cycles. Everything works in cycles. And so your point on vintages, right? Well, okay, investing now from private market and how that capital is getting deployed could be very different than it was 2-3 years ago or 2-3 years from now. So the ability to put together a well-constructed portfolio isn't a single year type item or a point in time, but it actually has to play itself out over years, given how maturities and vintages and taking advantage of the cycles comes into play. And we're speaking of everything on a primary basis. You mentioned earlier secondaries. What's a secondary?
So secondaries would say, okay, let's just use that typical example that we had where general partner has a fund, limited partner invests in that fund. That fund is investing in portfolio companies. Secondary transactions can happen at the company level where interests of a company are sold to another LP. But let's use this example where an LP has an interest in the fund, XYZ venture or XYZ private equity fund. For whatever reason, they weren't managing their cash flows appropriately, or maybe their risk parameters got too risky and they needed to raise some cash and sell off a position. Oftentimes they'll work with the general partner, or maybe the general partner is helping to facilitate that. But oftentimes they'll say, you know what, I can't redeem, but let me go off and see how I can sell my interest in this fund to another limited partner or a general partner raising a secondaries fund looking for these types of investments. There's a price to be paid for that generally. Because there's no liquidity here.
Right.
And so generally, that limited partner that is selling its interest in the fund, generally you're seeing discounts, and the discounts, range from is it venture, is it growth equity, where the discounts might be smaller, where you're getting maybe 90 cents on the dollar of what the general partner is reporting the value of the fund to be. Venture, it's going to be a much steeper discount because there's just a greater uncertainty of those underlying investments.
Right. And so thinking about that from participating in a secondaries market, somebody that's going into a fund manager, primary, right? They're saying, I'm committing capital to a fund that has no companies in it right now, right? They're committing capital to the
Blind pool,
manager. Well, back to managers matter. You're committing capital to this manager who's going to go off and find the companies to put into the portfolio as they buy them over time, as they leverage up your equity capital. So you are going in, blindly with the trust on that manager, their track record, their thought process, their investment thesis, their process disciplines that they're employing. But in the secondaries market, an investor wants to get out. The secondaries market provides liquidity into an otherwise illiquid market. And there's a price to pay for that liquidity by participating in a private market. Again, investor beware going into the private markets. If you got to get out, you're probably going to have to take a significant discount to unwind your position. It's another warning. But if you're on the other side of that, if you're not the one that's distressed that has to get out for the liquidity and you're the one providing the liquidity, now you're not investing in a blind pool. You're investing in the companies you actually know, 100%. And you're buying it at a discount. So the economics of participating in secondaries historically have proved quite fruitful to investors because of those dynamics.
It just provides a different risk-reward profile within secondaries because you mentioned, one, it's great to get things on discount, and two, if you're going into a general partner that is raising a secondaries fund that is going off and looking for these secondaries investments, they're allowed to do the due diligence on what that fund is already invested in, to be doing the due diligence to say, okay, is this worth 10 cents of the dollar?
Right.
Maybe, oh my gosh, that's a great deal. Or, you know what, maybe it's not. So that additional insight going in is where, secondaries just, again, diversifying across all these different avenues just provides a different risk profile versus what venture might provide, right?
Right. There's so in real estate, another sub-asset class segment, right? Real estate. In the past, you'd end up with non-traded REITs. Non-traded REITs, by definition, right? They're not publicly traded. They're non-traded. I think there was previously alerts from even FINRA that came out against non-traded REITs because they were paying huge commissions on the front end. Things again we didn't do and get involved with. But I think it's a good example of when things got democratized, maybe where they could get a bit sideways in terms of people buying in and thinking they were buying into private real estate.
Right.
But private real estate is a sub-asset class within the private markets if done the right way. And again, that's where we have to put caveats on all these things. It has to be done the right way to access that. So it's not all non-traded real estate is bad. That's not what I'm saying. But there's a right way of approaching it too.
Right. And you bring up a nice shift in terms of real estate because this ties in, again, back to the overall allocation and what overall allocation makes sense. Well, what is the portfolio objective you're wanting to achieve? Are you trying to maximize returns? Are you trying to increase your diversification and be hedged to your public market portfolio? Are you trying to look for tax-efficient investments? Real estate kind of hits that, one, yes, it provides solid returns. Oftentimes, depending on the strategy, returns tax-efficient cash flows too, and is probably one of the more diversifying private assets that you could introduce into a portfolio to kind of help reduce that overall risk of, generally thinking public equities, public debt. So again, depending on the portfolio objective and how much we want to, leverage and allocate to some of those objectives, real estate's a great avenue. But even within real estate, do we want to be ground up development? Do we want to be core? Do we want to be already invested in stabilized assets and just, get the cash flows off of it? Right, do we want to be on the debt side? So even within that, there's a lot of different things that will ebb and flow through time.
And like we said earlier too, different 1031 managers that come in. So a lot of what we've been hitting on is investment due diligence too, and like what am I investing in?
Yeah.
But a very significant part of our considerations came into, well, it's who are you going to the dance with, so to speak, right? Who's on the same side of the table as you? Why do we like this platform? Because it's not just about sourcing great managers and great investments. There's aspects then too of saying, okay, here's how they actually operate.
Yeah.
And what does operational due diligence mean? What does it look like? Case study, example type to bring it to life. Yeah. Because we look at that, as we know the platform does, to say operational due diligence can actually cease and stop an investment, even if it sounds like a great investment, if it doesn't, check all the boxes. What is operational due diligence?
Yeah. So whereas, again, to define investment due diligence, whereas due diligence on the investment side is really focused on the manager, the strategy. How are they bringing value to these companies to help grow, not just doing financial arbitrage, but how do we actually grow the bottom line so that the investment is worthwhile? All of those things that go into investment due diligence. Operational due diligence on the flip side is more on, I would say, legal, tax, financial reporting type things in terms of are the appropriate legal docs in place? How are they managing their cash and their cash controls? Do they have everything tied up with one bank and limiting their FDIC insurance coverage, or do they have it spread out across multiple banks? We often take that for granted, but then in the case of Silicon Valley Bank, there were a lot of banking clients that weren't doing that and were way overexposed to one bank. I guess a recent case study that we came across on a individual co-investment for a pretty high-profile tech investment. The operational due diligence team actually overrode the investment due diligence team because the general partner that the deal was being sourced from wouldn't provide some of the things as simple as proof of ownership, proof of shares, as taken for granted
something small like that, right?
Right. So
here, buy my car, but I'm not going to show you the title.
Exactly. So things like that, and that's maybe a glaring example. But things like that where the operational due diligence team says, yeah, it may be a great investment, but it's not worth the operational risk that we see as we look at this general partner or, this company as those general partners are doing due diligence on the companies. So we really, valued that, weighted that very heavily versus, again, all platforms have their trade-offs, but there were other ones where it just seemed like it was more of a consulting approach where it was a check the box of, okay, we've checked our 20 boxes on this manager and we're good, versus what I thought, the thoroughness of the investment and the operational due diligence was, with the team helping to support this platform, was really impressive. And I think, I mentioned access and the due diligence are the most important of the 6 categories that I think you mentioned.
Yeah. So as we start, winding down and final words of wisdom as we look forward, because we've come off the last several years of very positive equity market returns. The U.S. The last couple of years, fantastic. International outperforming on an unhedged basis, given currency dynamics that have taken place. It's been really strong equity markets. Valuations are arguably a little bit stretched in terms of where they're at. Doesn't mean you abandon it. It gets into the asset allocation of what you do in the public markets. But I do think there's going to be more time and attention paid to private market participation. And for the client families that we're serving. These are the conversations that we're having. What makes sense? How much? Where does it fit in the legal structure and the tax structure regarding the placement decision making that takes place? What vintages do we bring in? What capital do we have set aside for additional investments that are coming in? This is just part of our ongoing normal exploration with clients to be considering private markets. As you look forward for private markets and the role that it can play for investors, what are you hopeful for? What do you see coming into focus, right, with dynamics, with technology or artificial intelligence? I mean, how should investors very broadly be thinking about both public and private markets as they move forward?
Yeah, I would say you mentioned AI. A lot of obviously of the venture and growth equity is going into AI startups and AI companies. As I look forward, I think a few kind of broad trends. First on credit. One, the banks have actually stepped back away from a lot of the lending that they were doing, call it pre-GFC. And so they've really stepped away, and their weight of loans being issued is much lower. So I think private credit, private debt, corporate direct lending has actually provided a significant benefit to companies trying to raise funds to grow their enterprise through the debt market. So I think that is only going to continue. There's good in that. I think there's also some bad where you have new managers that really haven't gone through a credit cycle and what that actually means and what that looks like. Potentially seeing it, we don't know when, but at some point there will be a cycle, and you want a manager that has seen that, been through that knows how to manage it. So again, that's kind of the word of caution. There's the good and the word of caution in terms of credit. And equity, too, is not too dissimilar. I think because of the money going to private markets, these managers that are growing tremendously, you're seeing companies stay private longer and longer. Why do I want to open it up when I can easily get, you see these massive financing rounds going through. Why do I want to deal with the hassle of, quarterly earnings, right? Versus trying to grow and build. So I think you've seen, I'm hopeful that the IPO, window actually starts opening it up from its peak in 2021 or so. We're probably not going to get back to those levels, but to see some growth there would be positive. So I think there is something to say. There's a ton of companies out there. So being able to, again, further diversify your equity allocation to some of these private equity, I think makes sense. Doing it over time, because even within private equity, multiples aren't cheap by any stretch. Yet there's managers that focus on through market cycle type investments. And then the final thing too is just being able to manage the cash flows too, whether it's debt, equity. You mentioned vintage diversification. So being able to layer those investments in time. Well, on the back end too, is you're receiving distributions, getting a steady state of cash flows through those times to then either be saying, okay, well, now I've got a whole bunch of cash flow. Where is the best point for me to be allocating that to? Is it the public markets? Is it the private markets? 5-10 years from now, we'll see where opportunities are. So I think that's where managing then the liquidity, the cash flow off of those allocations to then be making new investments where opportunities present will be super critical for private market allocations.
Well, let's wrap it there. Listeners, the pace that we were just going through the content and the time that we have today is significant. We can't help but put a caveat on this at the end, just like we did in the beginning. This is not a recommendation for anyone, but we welcome the opportunity to have the conversation, explore this for you, already the clients of Clearwater Capital, those of you that might be tuning in to get to know us and how we think about this subject matter. It's not all or nothing. It's not all public markets or all your company or your private investments. It does come down to this global asset allocation, which includes both. And it includes other assets. When we talk about the passion assets, the collectibles that could come into play, private real estate, et cetera. So we do hope to have the opportunity. This is a great way to kick off the 2026 year, as this is going to be posted here January 1st. So Happy New Year, everyone. I hope your holidays with your family and friends was fantastic and just a great time of celebration to wind down the prior year. And as you start thinking about what's next, keep us in mind, reach out, send us an email at clearconversations@ccpwealth.com. Give us a call, find us on the website, and I hope you have a blessed day and a blessed year, everyone. Thank you.